Hello, I'm Peter Mauthe with Trademark Capital Management's review of the July 2024 FOMC meeting. Let's take a look at the Federal Reserve meeting notes from yesterday. The GDP economic growth is slowing, but constructively positive and steady. That's important to the Fed because they do not want to see a recession. And as long as there's no impending recession, that takes the motivation to lower rates a bit away from the table. Core PCE inflation is still running around 2.6%, but heading in the right direction, according to the Fed. Now, that's a good thing, but still it's above the 2% target the Fed has set. Unemployment is now at 4.1%, which is up from 3.6%, but it's still historically low. And in fact, over the last 5 or 6 decades, 4.1% unemployment would have been considered full employment. Now, these three items alone say the Fed is getting closer to reducing rates, but they're not there yet. And as such, yesterday, the Fed left interest rates the same. They did not lower interest rates yesterday. Balance sheet reduction is to continue, but they weren't specific whether at the current rate or at an accelerated or decelerated rate. Expectations were also set for a rate cut in September, given the above factors that are going in the direction that the Fed wants them to go in, but they're not there at the objective levels yet. However, they did leave the door open to the fact that they're still going to be data dependent and may not cut rates in September. Now, let's take a look at a chart we've looked at after prior meetings. This is in green, the 2-year Treasury note yield set by the open market, not by the Fed, and the federal funds target rate in black. Now, you can see that the open market rate set by the 2-year Treasury note has typically led, not lagged, the Fed funds rate. The important part about this is for many months now, the 2-year Treasury note has been suggesting that the Fed is behind the curve and should be lowering rates now and not leaving them at an elevated level. Now, this has been seen before, as we can see back here in 2006 and 2007. Nonetheless, the other important part about this graph is the red arrows indicate that when the Fed has had the motivation, meaning a weakening economy, especially a weakening economy, we have seen the Fed aggressively lower rates. Now, this happened at the end of the tech bubble in 2001. It happened at the beginning of the economic decline associated with the financial crisis. It happened in advance. Note I said in advance of the decline in the economy due to COVID. And while we don't know whether the economy will decline again, and the Fed will respond again as it has in the past 25 or 30 years with declining interest rates, that's yet to be seen. Now, let's see what this really means for investors. Taking the same graph, let's talk about the neutral rate of interest rates. If the Fed, or shall I say, when the Fed starts to lower rates, the Fed is likely to lower rates to a neutral rate associated with inflation. Now, based on inflation targets of around 2% and or likely lower, then we can expect the neutral rate on Fed funds to be somewhere between about 1.75% and 2.75%. Given that, we can expect longer term treasuries, let's call that 10 to 30 years, to yield a couple percent more than that neutral rate, and we'll call that 3.7% to maybe 4.25%. That will be the zone where we can expect treasury yields, longer dated treasury yields to go. And we can see mortgage rates a little bit higher than that, or at about 4.75% to 5.75%. Now, what that means is that for us, our kids and our grandkids, the 2 to 3% mortgages are unlikely to be seen in our lifetimes again, unless we see a cataclysmic type economic situation such as the financial crisis that gripped the world back in the 2008 to 2015 era. So that's the summary of the July 2024 Federal Open Market Committee meeting. Here at Trademark, you can follow us on our website. You can follow us on Twitter, now referred to as X, YouTube, and LinkedIn. Also, if you have any suggestions for future videos and/or commentaries, please reach out to us and let us know. Thank you for joining us.